Hello everyone. This video talks about the practice of option trading in developing economies and its implication to Nepal. Before going into what an option is, let us look at an example. Chanira owns a car. Sanim wants to buy that car, but he also wants to keep his options open in case he can find a better deal for himself. So what Sanim does is request an option to buy the car from Chanira at 10 lakh rupees anytime during the next month. Chanira agrees, but with the condition that Sanim pays her 2%, that is 20,000 rupees for reserving that car for him till the next month. Chanira cannot sell a car to anyone during the waiting period, and Sanim can buy that car exactly at 10 lakhs anytime during the next month. Now the catch is, since Sanim got into an option contract, he can simply choose to not buy the car despite Chanira's reservations. Thus, an option is defined as a contract that allows the recipient the right but not the obligation to buy or sell a particular asset at a predefined price and within a predefined time frame. In the derivatives market, you may want to buy shares or sell them at a specific price in the future. On this basis, there are two types of options available to us: call options and put options. Call options are those contracts that give buyers the right but not the obligation to buy the underlying shares or index in the future. Whereas put options are exactly the opposite, which gives buyers the right to sell in the future without the obligation to do so. When it comes to emerging economies, as of now they have a lower share in the total options turnover as compared to developed countries. In the interest rate segment, many economies have developed active over-the-counter markets for options. Some options, like Brazilian options, are non-deliverable, which means they are settled in domestic currency. Options allow for mitigation of risk routinely faced by investors, transferring the risks from those who do not wish to hold them to those who are willing to do so. What does the option market look like in some of the emerging economies around the world? Let us start with India. India has a population of 1.36 billion people, of which 52% are involved in agriculture. But agriculture only contributes to 13.9% of its national income. Because of its dependency in agriculture and low per capita income, India is a developing economy. In India, there are two types of options: individual stock options and indexes-based options. All options on individual stocks are American options, while all index-based options are European options. Options on individual equities and options on indices have enjoyed huge success in the Indian market, with daily turnover of over $20 billion. Moving on to China. China remains the largest developing country in terms of a wide range of indicators such as per capita levels, industrial structure, employment, innovation ability, and balance of development, among others. However, the Chinese options market was launched in 2011, which is 13 years after the derivatives market started in India. This came as a part of the nation's efforts to lure in more sophisticated investors to a market where individuals accounted for about 80% of equity trading and price swings were the biggest among the world's 15 biggest exchanges. The 50 ETF option was listed for transaction on the Shanghai Stock Exchange on 9th February 2015. This was the first option traded in the Chinese capital market and acted as the prelude to development of the options market there. The various types of options traded in China are equity-linked options, binary options, etc. Brazil is another developing economy with an active options market. In 1979, Brazil's two stock exchanges, both the Bovespa and BVRJ, started trading futures and options on individual stock. The Brazilian Futures Exchange was created in 1983 and offered both futures and options trading on stocks and stock indexes. In 2018, investors bought $1.4 billion of contract on a day. On that day, just 7 trades were recorded, indicating that the buyers were making large wagers. Let us look at the Nepalese context. Nepal needs wide reforms in its existing laws on financial derivatives to adjust to swaps, forwards, as well as the options market. Existing legislations have paved the way for the development of commodity derivatives market in Nepal. However, much needs to be done on this regard and strengthening SEBON as an apex regulator of commodity derivatives market. If the derivatives market, including the options market, starts to flourish, then Nepalese will have more hedging opportunities. This is because when commodity and derivatives market widen, farmers, manufacturers, investors, corporations, international traders, and nations in general will be benefited. Talking about the major benefits of options trading and derivatives market for a country like Nepal, since options are available in a wide range of instruments such as agricultural products, metals, foreign currencies, interest rates, soft commodities, index products, energy products, etc., this leaves a wide scope for options trading opportunities at almost any time. Derivatives market, especially options trading, creates a suitable environment for Nepalese farmers, along with yashagumba and other medicinal and aromatic herb vendors, as well as collectors. It is because options save them from incurring heavy losses due to high price volatility of these commodities. Financial institutions can mitigate or even eliminate the interest rate risk by locking the interest rate with derivative exchange. Utilizing this market, investors have the advantage to determine the conditions of the contract that they wish to enter. In conclusion, being an agricultural country, options trading creates huge opportunities for Nepalese investors. Therefore, acknowledging the scope of options market in the developing economies such as Asian countries, there is high potential and benefits of hedging the risk in Nepalese context as well.